Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Good afternoon, good evening, and good morning. Welcome to Panel 14, Oil and Gas Funding Strategies Supporting the Energy Transition. I am your moderator, Claire Francis, Head of Client Coverage for Europe. Well, as far as the backdrop is concerned, we've all seen significant price volatility, and sustainability will continue to shape the future of the oil and gas industry. Maintaining reliable funding flows to allow this sector to transition towards a lower carbon future is going to require our skill, our strategy, and of course, our relationships. How the oil and gas companies are navigating these transitionary and turbulent times, what strategic roles our CFOs, treasurers, and private equity investors are going to be playing is going to be significant. So welcome to our diverse and distinguished panel today. Firstly, Richard Wheatley, Treasury Vice President and Head of Liquidity at BP. And within BP, Richard has accountability for all of BP's cash and banking, capital markets activity, and management of the 27-strong relationship banking group. Richard is also a director of BP Shipping, a member of the CBI Economic Growth Board. And over his career, Richard has had varied experience across manufacturing, trading, supply and marketing, and experience along, together with BP's West Coast downstream businesses. Welcome, Richard.
Thank you, Claire. Good to be here.
We're also joined by Neil Shah. Neil Shah is the CFO of Kosmos Energy. Now, Neil joined Kosmos Energy back in 2010, serving in a series of roles across finance, treasury, investor relations, and international operations, and has also been head of the Equatorial Guinea business unit. Before Kosmos, Neil was actually on the dark side as an investment banker at Morgan Stanley, assisting many oil and gas companies. Welcome, Neil.
Thank you, Claire. Happy to be here.
Guido Funes-Nova is Managing Director of the Carlyle Group, and Guido focuses on many private equity investments in the energy space across oil and gas in particular, and is a member of the Carlyle International Energy Partners investment team. Guido brings with him considerable experience in private equity investments in Europe and sub-Saharan Africa, and has been involved in many investments known to you as Varo, Siricol, Cepsa, Nuyon, Discover, J&J Africa, amongst others. And last but not least, we have Morten Llewellyn, our Managing Director of Leveraged and Acquisition Finance at Standard Chartered. Morten is a highly experienced debt capital market banker who's recently led loan syndications across Americas, and also our high yield capital markets team across both Europe and Americas. So a vast amount of experience coming to you today. So as your moderator, I'm going to turn to our first question, and our first question really does relate to the recent market volatility and subsequent recovery, something that's on all of your minds. Over the last 18 months, due to the pandemic, we've seen Brent falling in January 20 at 70, down to $25 in April, and gradually recovering back up to 70. So in view of the global challenges, we've seen unprecedented support from central banks as they've supported the markets. And as we hopefully see an exit to the pandemic, clearly what's going to be very important to all of us is how the capital markets have recovered, and also effectively how we secure financing in the future. So let's start with Richard firstly. Richard, with a 65 billion debt to manage on your balance sheet and a very strong investment grade rating, how did you react to the challenges of 2020, both in terms of straight issuance and, of course, the successful hybrids? And what was your thought process?
Yeah, thank you, Claire. It was an unprecedented set of circumstances last year that I think the industry faced. I think we had triple threats. Also, we had the breakdown of OPEC Plus in early March, the real uncertainty caused by the pandemic and impact on demand across our industry, and also, the historical hedge, if you like, between the upstream and downstream businesses in the oil and gas industry actually, didn't function in that environment. So, it was very uncertain and very unchallenging times for companies such as BP and for many others in our sector. I would say for us at BP, the key learnings and experiences over the course of the last 18 months were threefold. Firstly, it was really important to be prepared from a liquidity management perspective, and we had actually invested a quite significant amount of effort around making sure our stress tests were up to date coming into this crisis, that our understanding of our contingency funding approaches would be in good shape when we came into a crisis, and that we had a really good source of bank group, if you like, to work with should we find ourselves in a difficult situation. So being prepared really served us well. You never really know when these crises are going to happen, so important you do the legwork. So being prepared was the first lesson for us. Secondly, it was about being decisive. So within a week of lockdowns threatening Western Europe and OPEC Plus breaking down, we had managed to secure an underwritten $10 billion revolving credit facility. And that was a landmark transaction for us and for the industry, I think, in terms of showing that the market access was still there for the oil and gas sector in terms of leveraged finance. And it gave a lot of confidence to rating agencies, to investors, to stakeholders, and to the company itself that from a liquidity perspective, we would be in a strong position. So being decisive was important. And that set us, in a good stall forward in terms of our, forward activity through the course of 2020. And then the third area I would describe that was important for us was about being innovative. You talked about the hybrid issuance, which was the first of its kind for BP, which we did in almost 12 months ago, actually in mid-June last year. And for us, that was a part of a strategy that we had to diversify our investor base. I think the pandemic actually allowed us to think differently about our investor base and about our funding strategy. We also took advantage, of course, of the low rate environment to extend duration significantly, as did other companies. And for us, that was been a very successful strategy. So the hybrids were a great success, but so was our strategy of lengthening duration. And also we put in place a new European issuer registered in the Netherlands to allow us to access the European Central Bank funding and a different set of investors in Europe as well. So being prepared, being decisive, and being innovative actually were the key learnings that we had through 2020, and that served us well as BP. And we're pleased with what we managed to achieve from a funding perspective last year, and I think that set us in good foundations for the coming years and coming challenges. I mean, it's an old maxim, but you should never let a good crisis go to waste, and I think that was what we were fortunate enough to do last year.
Very much, Richard. So I'm going to pass to Neil. Now, Neil, as a sub-investment grade issuer, you'll have seen spreads widen dramatically over the last 18 months. I know that you've said to me that apart from patience waiting for markets to recover, I know obviously you responded and had to respond in a different way. Maybe you could give us your thoughts.
Yeah, I mean, as a sub-investment grade issuer, I think access to market isn't always guaranteed, and therefore, from an issuer's perspective, I think there's two things that sort of come to mind in terms of things that were highlighted in the last 18 months. One, was really around creativity. As traditional markets shut down or access to capital isn't available, it's important for sort of issuers, particularly in sort of the small to mid-cap space, to make sure they have access to various markets. We entered into a prepay agreement and then a term loan for $200 million in the fall of last year, which buffered our liquidity and we were able to secure it at a pretty low cost. And then earlier this year, as the high yield markets changed, we were able to access that market and increase our liquidity and push the duration of our debt maturities. And so, keeping the options open and evaluating them on a continuous basis, and also looking for sort of slightly different structures, I think is a key for particularly sub-investment grade issuers. Many looked at converts, hybrids, etc. And I think particularly within the E&P space, that volatility drives people and companies to look at alternative markets. So having access to those markets and ensuring that you can tap various sources of capital is particularly important, especially in our size.
Thanks, Neil. I'm going to come to Guido. So Guido, as effectively an owner, an active acquirer, how did you see the market behave, and how do you think the markets will develop? Do you see the oil and gas market becoming increasingly capital market dependent? What are your thoughts?
Well, that's a great question. I think we're all dealing with it now because it is happening. What happened last year is that the shock was huge across the entire value chain. Our team manages about a dozen portfolio companies that range from E&P to refining and marketing all the way down to petrochemicals, and also span the entire credit range from investment grade to sub-investment grade. In some cases, liquidity and access to capital was completely shut off. There was no access to capital markets, for example, for the sub-investment grade companies. The investment grade companies had to pay a little bit more, but the market was open. The irony is that the overall cost or the premium for what we thought was insurance money was relatively limited, and therefore we raised about €1 billion. I'm thinking of one portfolio company of ours in particular, through the capital markets, just to increase liquidity. In other cases, we had to work with our relationship banks and increase liquidity by raising commitments from our traditional lenders. Luckily, we went into the crisis with very prudent capital structures, and we were very well hedged across the entire portfolio. So that proved that especially for the sub-investment grade players or the independents, it's really important to have prudent levels of leverage, very high levels of liquidity, and be hedged, because you need to withstand the shock as you work it out with your partners in the financial markets. But certainly the results of the crisis is that a bunch of banks have left the space. And therefore, the traditional banking market, which in Europe is the one we're mostly reliant on, is smaller. And the bar has gone up because banks have suffered losses and because they now have different policies. So that's the question for 2021, having survived 2020. How do we move forward? I think we all need to make an effort to find ways to attract capital by showing that effectively by remunerating ESG policies that are effective, so that I believe lenders eventually will discern between the companies that can manage and make a difference, manage a problem and make a difference, versus the ones that are static or have a static approach to the problem.
Thanks, Guido. Well, I'm going to come on to M&A, but before I do, let's go to Morten. Clearly, Morten, from a capital markets perspective, you lived through the volatility. Any thoughts?
Well, thanks, Claire. I mean, look, the panelists, the other panelists have all reflected on the situation. Now, they've all mentioned the point of prudence and having a prudent capital structure, whether you're an investment grade or sub-investment grade. That obviously gives you the ability to weather the storms of the last 12 to 18 months. And then the other key messages here really are, firstly, capital markets evolve. They always have done, they always will do, and they will continue to do so to support viable situations. So there's clearly, going back to Guido's point, is how these markets are going to evolve in time. I think that's a big area of interest. Going back to Neil's and indeed Richard's point, alternative sources of capital. They both reached out to different sources of capital than they traditionally used. And that's there. There's liquidity, new pools of liquidity coming from the huge and growing institutional investor base that's out there. So that's something which is really striking, and that's obviously what all capital market bankers and advisors want to be on top of. And then finally, I mean, this is best demonstrated from the sub-investment grade markets themselves, is recovery. The markets, the high yield markets, do go through these periods when they close, but they close for short periods. They always reopen, and they're always there to support the viable businesses that are out there in the market. So that's my reflection on last year and what I've just heard from my other panelists.
Thanks very much, Morten. Well, let me just ask the panelists. I mean, clearly a lot of transition, a lot of volatility. How do you think this has impacted M&A, and what do you think that we will see in terms of divestment opportunities? It might just be an idea if I was to go to Neil, just to get his high-level views in terms of divestment or M&A or any activity that you think will be prudent on the back of the recent volatility.
Yeah, thanks, Claire. I think there's two things from my perspective, and some of it sort of combines with what we'll talk about later in terms of the energy transition. But I think particularly in the last sort of 12 months, I think it's highlighted a couple of things, which is you're seeing, especially within the sub-in grade market, significant consolidation, which goes back to the point around access to capital, and that those who have to retain access to capital in the future, it's important to have larger scale and sort of better credit metrics, and people are finding sort of synergy and scale lowering the cost of capital and retaining access to capital is important, and therefore. We have seen a wave of consolidation, particularly in the U.S., and we're sort of starting to see it in the international space. And so I think that's a trend that we'll see continue. And I think the other part sort of correlated to that is really around people's portfolio shapes. Related to the energy transition, because it's somewhat gone sort of in time in parallel. Over the last year, as people are evaluating how do their portfolios fit for the energy transition, and therefore are making portfolio choices to define what it looks like, not just sort of now, but in 5 years or 10 years from now. And so that's created more opportunity, especially for a company like us, who are looking to grow and focus on what we want to do. We made some important portfolio choices last year to sell our frontier oil exploration portfolio and focus on shorter cycle oil, which has sort of faster paybacks and better risk-adjusted returns, and made it a decision to sort of invest more capital within the LNG business along with BP. And so I do think how people are making choices. In terms of what they want their portfolio shape to look like will drive, the other set of M&A, out of this sort of downturn.
Thanks, Neil. Maybe let's just come to Richard on the point of consolidation, divestments, transition. Any thoughts from your side, Richard?
Yes, Claire. I think for us as an industry, the stakes are incredibly high right now. The energy transition brings with it not just a huge business opportunity, but a lot of societal expectations too, and we're seeing that play out, in some of the recent AGMs and shareholder actions. It's an incredible time, I think, for our industry in that regard, and what that will mean for portfolios. With that comes a huge set of opportunities, and it's probably the biggest set of opportunities that I've seen in my 25 plus years in the industry. And actually, how you make choices is probably. Of what not to do is probably in some ways more difficult than what to do. If you take BP for example, we're on a transition from being an international oil company to an integrated energy company with an ambition to be net zero by 2050 or sooner. Clearly, that brings with it some significant portfolio choices for us. We've already announced that by the end of the decade, our oil and gas production will reduce by 40%. Of course, that will bring with it some portfolio choices. And with that also in parallel, we're looking to build out our renewable energy capacity, both wind and solar. Again, a huge amount of opportunities for us to contemplate. And it's interesting when you look at both on the, if you like, on the acquisition side for us, there are definite synergies I think that we can bring as a company like BP into the renewable space, whether that be things like our large project experience, our subsurface capability when you think about things like offshore wind, our balance sheet, of course, and also our trading capability. So I do think for our industry, as we think about acquisition, we have to think about sources of value. And I think for companies like BP, we have some really interesting sources of value to bring to the M&A space. Clearly, on the divestment side, we've announced, I think, a $25 billion divestment program by the middle of the decade. We're roughly halfway through that in terms of what we've announced thus far, and we continue to see good interest in a lot of our portfolio. We've done a lot of high grading of our portfolio over the course of the last decade. I think that has served us well. It's really important to have competitive barrels in your legacy oil and gas production. We're focusing a lot more on sort of brownfield and infill drilling type activity, on that part of the portfolio too. So I think for us, it's the portfolio quality on the legacy business is critical, and making sure you're clear on your sources of value where you could add value to renewables type investment is important too, because clearly there's a lot of competition in that space too. But we think we can definitely compete. So I think some really fascinating opportunities to play out for our sector. And actually, as I said, I think it's probably the most exciting set of opportunities that I've seen both on the acquisition and on the divestment.
Thanks very much, Richard. And of course, Guido, you have a lot of experience in terms of the transition and what you're experiencing. Do you want to just give us your thoughts in terms of energy transition, what you're seeing from an investment perspective, and what it means to you at Carlyle?
I echo what Richard said. It's an exciting moment because things are changing and therefore opportunities are arising. We need to find a way to play these new themes. I think there's really a bifurcation between our E&P portfolio, our upstream portfolio, and the downstream portfolio. For the upstream portfolio, what we need to do is focus on lowering the cost position of our business, being extremely efficient in the way we produce, in terms of cost and in terms of emissions, because that is, in our view, the way to play the energy transition. So you have to have barrels that will be the survivors over the long term, and you have to be able to compete or to be extremely competitive in terms of cost positioning. And you also need to reduce your emissions, otherwise those assets become effectively untouchable and unfinanceable. On the downstream side, I think there is more fun to be had because there are more things that you can do. There's obviously the efficiency bit that I just mentioned, but you can play it also in a different way. Biofuels, hydrogen, renewables, trading of all these things, plus the certificates that are generated by everything that I have just said. That comes with investments. That's the big question for us because you have the risk for everybody is to invest a lot of money, having to wait for a few years before those investments come to fruition and start generating cash flows. And then the market, which is changing, might take a different turn than what you have expected. Yet it's really exciting because I and we believe that there will be a large number of players that will not be able to adapt. And so those who are faster and are more focused on the transition and have the access to capital and the way to build partnerships should be the winners in this market that's changing.
I couldn't agree more, Guido. I'm going to bring in Morten here, who's obviously living through transition across a whole array of clients. Morten, do you want to just give some thoughts in terms of the energy transition as you see it, in terms of specifics and what you're seeing in your role?
Very, very difficult to be specific, candidly, because it's clearly a very there's a lot of conversation around it, around the whole transition subject. Huge amount of conversation, as this panel will be very aware of, on a daily basis, dominates the business press. So there's a lot there, and there's frankly, and I'm sure the panelists will talk about this. There's how do you manage that from their perspective, as an operational perspective? In terms of financing, I think it's still early days. There are clearly successful attempts to incorporate in both loan documentation and bond documentation, ESG KPIs or similar items in there, just to represent these instruments in an ESG manner, and that is an evolving, growing market, and there is evidence in certain parts of the capital markets that that does bring pricing benefit. Again, though, I think it's still relatively early days, and it's something which is going to evolve very clearly over time. What that time frame is, we don't know at this stage. I think the other thing is, going back to Guido's point, what is financeable, what isn't financeable. I mean, certain assets will increasingly become less financeable, certainly from a debt perspective as well. And then you move into the new emerging businesses out there, and how do you finance them? To what extent can you rely on the debt markets to finance them? How much equity do you need to support the business of those, let's call them growth areas? And that's going to be back to the classic, from a debt perspective, cash flow analysis, however you do it. And to what extent can the debt provider take on some elements of equity risk in the provision of financing? It's an exciting time on the financing side, as well as on the operational business side. And I think there's just a lot of learning to be done and achieved.
Morten, I'm going to go over to Neil on the transition and the transition financing side, and you gave us some very good insight on transition financing. I mean, clearly financing green and green moving forward. Do you just want to give us your thoughts to that in terms of market availability, what you think could be needed? Any thoughts there, Neil?
Yeah, so as Morten said, I think it is an evolving space in terms of how investors and banks are looking at providing that capital, particularly to upstream companies. And I think with regards to the energy transition, how they review or incorporate that into their sort of evaluations. So I think that's sort of a moving target, as we've seen, as we recently went to the bond market, and we recently extended our bank facilities as well. And so, I think from the corporate side, it's important that companies are clear and can articulate, how they've evolved their business and strategies to deal with the energy transition, to address the risk, and insulate both their credit and equity investors. And I think that, for me, is the most important part of the conversation, and where we spent the most amount of time with investors is actually walking them through the concrete steps we've made in the portfolio choices we've made, the investments we're making in the shape of our portfolio going forward, in addition to sort of our emissions reduction targets. I think all too often we get very people get bogged down in terms of trying to figure out what is the right quantitative way in which to demonstrate that you've the companies that you're investing in are sort of in alignment with your values. And I think we're not at that stage in the market today. We are in a place where it needs to, particularly in the next sort of I'd say particularly in the near term, rely on more qualitative assessment in terms of, is the business doing the right things? And over that time, over the next several years, we'll get to a more streamlined quantitative assessment. I think so. We are at a tricky point. Things are changing quickly. Companies need to be clear in terms of how they're making changes and lowering emissions. If they can do that, I think particularly in the near term, you'll retain access to capital and people will support you. And then in the medium term, it will shift to, what are the right metrics and how can you define that? But I think that's only part of the overall puzzle. But but it is, I don't have any investor conversations today where that's not part of the discussion topic, but luckily it's one in which the investors are focused on the right thing, which is what are we doing as a business to manage the risk.
Well said, Neil. So, Richard, I mean, transition at BP, you've made some very sort of punchy views to the market, and clearly you're living through transition all the time and the thoughts of greening. Do you just want to give us your thoughts on transition, what's really important to you, and how you sort of see certain components sort of moving out?
Yeah, thanks, Claire. I mean, obviously it's a huge topic. So I'll try to be brief, but there's a lot of content here, I think. As I mentioned before, we have an ambitious new strategy to achieve net zero emissions by 2050 or sooner, make this transition from an international oil company to an integrated energy company. To give you some color on that, by 2030, we're looking to increase our investment in renewables by a factor of 10. We're looking to increase also by 2030 our number of EV charging points by a factor of 10 to over 70,000. And we're looking to increase our installed capacity of our solar development up to 50 gigawatts by the end of the decade. So we have some pretty big ambitions out there as BP. And it's a sign of the commitment we have as a company to make the transition, to make good on our commitments around being net zero by 2050 or sooner. But it's important to realise that this is not an overnight switch. It will take a little bit of time to achieve, and we call that process at BP greening, right? So there are many thousands of companies in the same place as us who have to make this transition. Whether you be in the energy sector, industrial manufacturing sector, you have to make this transition from historical set of emissions and ways of working to a more societal and climate friendly perspective. And for us, at BP, we want to be part of that transition. We want to be part of that debate. And I think it is really important as we engage. You talk about transition finance. As to engage with investors, that we have an open dialogue with all stakeholders, not just investors, regulators, commentators, etc., to make sure that these greening companies are part of that debate, are part of the transition, are part of the solution. Frankly, Mark Carney himself said, if you want to reduce emissions, you need to go where the emissions currently are coming from, and they are from sectors like oil and gas, but they are from other sectors, say like transport, like heavy manufacturing, etc. So it's important that companies like us are seen as part of the solution, and for us, continue to engage more actively and proactively with investors is critical to that. I agree with what Neil says. We need to understand, therefore, and help the investors with their decision-making process. For us at BP, we're putting a lot of emphasis on making sure our strategy is understood. Our disclosures are fit for purpose for investors to make their decisions. It's only when you have those in place do you create the right conditions for sustainable financing, in our opinion. So there is, I think there is also, as Neil said, some evolving and maturing of the sustainable financing and transition financing market to happen. And it's important, as companies like BP remain humble, remain open to being held to account by our shareholders, by our stakeholders, but doing that in an active and constructive dialogue, which encourages companies like us to green, to be part of the greening solution, and to make this transition what it needs to be for society. So I'll pause there, Claire, or else I'll probably take the rest of the time up.
Thanks, Richard. I think you took the words out of many of our mouths, so thank you for that. But I'm going to come to Guido. So Guido, as a private investor, and obviously looking at the public markets as well, how do you look at these increasing requirements to transition, and how do you manage all these stakeholders?
Oh, well, that's another great question, and that's what Richard was I think saying now. You have to engage with your investors. Are those who provide equity to us, the equity that we're then deploying into our investments, and the providers of finance, so banks, the capital markets, sometimes partners in the industry when we do prepays. I think our job is, so far the discussion has been around, has been qualitative, which is what Neil was suggesting earlier. You had to demonstrate that you knew what was happening, you were on top of things, and you were controlling the evolution. But there was not really a quantitative approach. There was no measuring of goals goals, no setting of goals, and then measuring progress against those goals. But that is changing very quickly. So all our portfolio is transitioning to a more quantitative framework, because you'll be held to account. And as I said earlier, you have to demonstrate that you deserve the capital, and that capital can make the difference. Otherwise, you lose the access to that capital. So there's a lot of discussion that we need to have with our investors. You have to help investors see through the fog, because oil and gas here, whether we like it or not, is destined to be around for a very long time still. So the thing that we can do is we can produce it more efficiently, and we can transition to other forms of energies, but managing the decline of the industry, or the transitioning better of the industry. Otherwise, especially last year, up until last year, there was a lot of noise around the energy transition. Some investors were literally suggesting that oil and gas would disappear on the 1st of January of 2021, and everybody will be driving electric cars, which I think is an unsophisticated approach. I think with what we've seen last year, the importance to investors now see through the fog and are now rationing their capital, and they're only giving it to companies that can make a difference. I know I'm repeating what I've been saying, because that's really what I think. And in a way, the question you've asked so far, at least to me, have been more or less always the same. So variations on the theme: how do you attract capital? How do you get access to capital? How do you explain to your investors to give you capital? So the answer is more or less always the same. You have to demonstrate that you can make the difference, that your capital, or the capital that is given to you, is in good hands, and that will not become stranded.
Thanks, Guido. Well, look, let's move on to the cost of that capital. And clearly, transitioning to low or carbon neutral will involve financial cost. So I guess the question is how do you expect to manage these costs and associated funding? And do you see the emergence of new capital sources to support this transition? Any thoughts? Richard, did you want to give us any thoughts on that? Or maybe?
Yeah, I mean, I think, I think it's important. I think as the transition happens, that everything that is green is not just necessarily always just seen as good, and everything else therefore is bad, right? And again, this is where this concept, I think, of greening is important. I mean, we've been encouraged by the reception that we've seen in capital markets in recent months. We've issued our first ever 40-year bond, for example, a few months ago, which showed great confidence, I think, in the capital markets view of companies such as BP in our sector. So to the point that Guido's making, I think this transition actually, from a financing perspective, will take some time, and investors actually told us I would say with caution, but just be careful. They should be careful. Your access is good. It's important to keep the dialogue going. We speak to a plethora of investors, and they all tell us that they want slightly different things. I think what is important is if you think about things like metrics that the asset managers are using and portfolio managers are using for making decisions. There is a plethora of those metrics exist within the industry. I think they're confusing actually a little bit for investors, and they're evolving. When we speak to investors, they tell us they take a number of data sources and then create their own metrics and models, and that tells us that there's limitations in what is being publicly available in this space as well. So I think there's a lot of evolving still to do, Claire. Both in the decision-making criteria, how then funds are then constructed, what it means to participate. And for us, retaining flexibility, retaining good quality engagement with investors, and making sure that we can focus very clearly on our strategy, is important. Without a very clear and coherent strategy, as I described, backed up by very transparent disclosures, then I think you're going to struggle to find your way into portfolios or find your way into discussions about alternative sources of financing. Clearly, what else we also hear from investors is that you you need to maintain a really strong sense of capital and cost discipline. And that's something that we've made sure that we've articulated clearly through our new strategy and new financial framework. Because as Guido says, competitiveness is going to be critical, both to make sure that you can have the most competitive, if you like, legacy asset position, and also to make sure that your investment choices around the renewable portfolio are, get the level of returns that that your investors are expecting. So again, I think the key message for us is I think this has got a lot of there's a lot of evolving still to do. I think engagement is critical, and we need to make sure that companies that are greening are seen as part of that solution and not excluded from things like taxonomies or the like. And again, these are areas that are important for us as BP to focus on as we move forward.
Thanks, Richard. Well, I'm going to come back to taxonomies, but before I do, Neil, do you just want to pick up on the cost of transition funding from your perspective?
Yeah, sure, Claire. No, it's interesting because we had a long discussion with our banks when we went through our extension conversations a few months ago, and we did. We were the first sort of emerging markets company to put sort of an ESG linkage within our RBL facility. And it was a long discussion with the banks and both with sort of our bankers and with their sustainability teams over what that looks like and how does it work. And interesting, so ultimately, what we've created is sort of a framework where we can get a reduction on our margin if we comply with our sort of aggression emissions targets. We've said we're going to be Scope 1 and Scope 2 carbon neutral by the end of 2030 or sooner. And so part of the benefit that we get in terms of lower margin is from actually realizing that and delivering that objective. And then the other is around maintaining high sort of ESG ratings in the totality. And that was important for us to demonstrate that it's not just about sort of the emissions, it's about sort of the S and G are important as well. And so, particularly as a business that does, primarily operates out of West Africa, working to develop and improve the lives of the areas and the countries in which we operate has always been a key part of the Cosmos story. And so we have found a way to sort of thread that needle to get a benefit and lower the cost of ultimate funding as a result of that. But if you sort of step back, so there is incentive and alignment to deliver on the ESG objectives, which I think puts us in the same place as the banks. But almost back to Guido's point, I think sort of in the medium term, it's not going to be a question of sort of margin reduction as much as it is absolute access to capital. Unless you are clear on that agenda, the spread in capital will be so wide that it's not necessarily a lower cost, it's just access. And so that's, in my mind, is sort of, again, I think the benefit and the alignment in terms of margin reduction and sustainability linked is important, but I think that's ultimately just a bridge to get to where, all investors, where, when they do come up with, whatever the right metric is that they want to use, will ultimately be sort of investable, non-investable.
Okay, well, look, gentlemen, we could go on for such a long time. We're going to have to come now to closing thoughts. Before I ask you just to summarise in a couple of sentences in terms of your roles and what you see the next couple of years playing out. Clearly, we are moving into a new taxonomies. We've brought it up a lot. We've got COP26 on the horizon this year. Some very good change and some real excitement in terms of the transition. We're all on the journey in terms of to net zero. So let's just quickly get closing thoughts. We've got about 30 seconds each. So Neil, do you want to kick off in terms of closing thoughts?
Sure. I think it's a really interesting time to have this conversation. The environment, we've seen a lot of change, as you mentioned, in the last 18 months. I think that creates a lot of opportunities for companies who are sort of energetic and want to work together with their investors to manage through the energy transition, not only to deliver value, but actually do it in a sustainable way. And so, I think, for companies, especially in our space, there is a lot of opportunity and there will be a lot of change and it will take a lot of discussion. But if you're doing things the right way, if you have the right strategy, and you're in active discussion and dialogue with your investors, it'll be sort of a continuous feedback loop to sort of continuous improvement.
Neil, let's go to Guido. Let's try and, before the clock stops us, Guido, closing thoughts.
Sure. Capital will be much more selective going forward, and it will remunerate or be accessible for the people who are able to show that they can make a difference.
Thanks, Guido. And Richard, what does the future hold?
Yeah, I think it is a future that requires, all of us to be part of the transition. So companies that are greening are as important as renewable companies or legacy companies. It's really a key time for us to come together and to finance and manage this transition as a world, as a community. So look forward to that, Claire. Thank you.
Thanks a lot. And gentlemen, thank you so much. Guido, Neil, Richard, Morten, fantastic. We could have gone on all afternoon, all morning. So thank you very much. A really, really great session. Thank you all.
Thank you, Claire.